everybody in Congress thought that you had to get money through taxes to be able to spend. And what you did get, you had to then borrow and leave the debt to the next generation, right? And so we're just looking here, okay, well, they've got that sequence backwards, and that's why they're afraid of default. Where is the money going to come from? Because once you understand that the government spends first, which then supplies the economy, so to speak, with the funds to pay the tax or with the funds to buy the bonds, the whole idea of solvency doesn't make any sense. So that's why there's no default risk.
This is the MMT Podcast with Patricia Pino and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. For as little as $1 a month, you can get early access to all our episodes and patron-only episodes. A big thank you to all our supporters so far. At the beginning there, you heard MMT co-founder Warren Mosler, and in a moment you'll hear Warren in conversation with author and MMT scholar Phil Armstrong at an event which took place on the 17th of October 2020. I've linked in the show notes to where you can go and support the organisers of the event, the Gower Initiative for Modern Money Studies, and their website is also where you'll soon be able to see video of the event and sign up for email alerts about upcoming events. Warren is considered by many to be the father of MMT, and his early insights came from studying closely what happens in the banking system when governments spend, which is that new currency units, dollars, pounds, yen, etc., are created. So if you're living in a country with a modern money system, such as the UK, the US, Japan, Canada, or Australia, with a government that issues its own currency, that government cannot run out of its own currency. So then it follows that for nations like these, austerity and fiscal conservatism and all the destruction that goes with it is completely unnecessary. And there's a growing number of people who think that that's quite important information right now as politicians tell us daily how hard it is for them to keep making tough choices on our behalf about how rubbish they're going to have to make all of our lives for the foreseeable future. There's nothing worse than a tough choice, and I just want to help these martyrs of decision making to not suffer anymore. But in order to get the message to them, grassroots activists have to get to grips with a few aspects of government spending and central banking that can be a bit tricky. And that's what this podcast series is all about. So before we dive into this episode, if at any point you feel you're getting left behind by any of the points being made, don't panic. I've linked to our first 3 episodes where me and Patricia lay out some basics in a hopefully easy to understand way. Also, I've linked to all our episodes with Warren, and as you'll hear, Warren is a great communicator, so going through our episodes with him in order is also a great way to get up to speed. In the interview, you'll hear Warren talk about some insights that he feels could do with a little more emphasis from more seasoned MMT proponents. One is that orthodox and some heterodox economists have got their understanding of the function of interest rates backwards. It's Warren's view that raising interest rates likely imparts an inflationary bias to the economy, and that lowering rates is deflationary, and that this is due to, among other things, something called the interest income channel. And we unpack that a little bit more with Warren in our episode 59, which I've linked to in the show notes. I've also linked to all of our episodes with Phil Armstrong, who is Warren's interviewer for this event. And at the beginning of our episode 50 with Phil, there's an explanation of Warren's early observation that government bond sales are a reserve drain, which gets touched on in this interview. Now, if some of this stuff sounds a bit esoteric, please bear with it. We've all been there. And it's unfortunate that this simple, obvious truth that your national currency is manufactured and that only one entity can authorize its manufacture, and that entity is the government. And so your government, being the issuer of currency, on a point of logic, can't run out of that currency. It's unfortunate that this truth has been shrouded in magic and mystery by a nexus of think tanks and grifters, but we're here to help you excavate it. It takes a bit of time, but you can do it. As ever, I've linked to where you can support this podcast financially via patreon.com/MMT podcast. Support starts at $1 a month, which is 78 British pence at the time of recording. And no matter what level of support you give, you get early access to all our episodes and patron-only episodes where you can ask me and Patricia MMT questions. Thanks for the time you put into learning and spreading the word about MMT. And thanks again to Sarah, Claire and Prue from GIMS for organising this event. We start with opening remarks from Prue. Let's dive in.
Good afternoon, everybody. The GIMS team is absolutely delighted to welcome you all to our third online event. Now, just over a week ago, GIMS celebrated its second birthday following its launch in London on the 5th of October 2018. Since then, the team has been working really hard to raise awareness through live events, social media, and its weekly blog news roundup to bring modern monetary reality into the public domain. It's been both a lot of hard work, but also an honour to be part of this growing movement across the world, which is starting to bear fruit. COVID-19 has, without a doubt, presented us, as with many organisations, with new challenges in terms of its outreach. As such, meetings become the norm. We hope to be able to continue our work with just as much enthusiasm and dedication in hope of better times to come. If you've been to one of our events before, it's really good to see you back. But for those perhaps for whom it is the first time, a very warm welcome. And we hope that this event will inspire you to follow our work and learn more. Our objective is to provide an educational platform to challenge the economic orthodoxy that has defined our age. Our world has changed irrevocably in the last few months, and COVID-19 has revealed a public infrastructure unable to cope with the pressures placed upon it due to spending cuts and other agenda-driven policies imposed by successive governments. As poverty and inequality rises and the tidal wave of climate change bears down upon us, solutions must be found. Creating a more equitable and fair and environmentally sustainable world should be at the top of our agenda. Achieving those aims demands a public conversation about our political and societal priorities and a realistic examination of the possibilities and constraints that exist to deliver them. Understanding how governments such as the UK's really spend will enable us to consider what our priorities should be and how they can be realised. Before I hand you over to our guests, just to remind you, GIMS has a website which is full of useful resources and links to external ones, and where you can sign up to our newsletter for updates and make donations. We are a voluntary organisation and we depend on your contributions to continue our work. And again, I'd also like to give a quick plug to the MMT podcast with Christian Riley and Patricia Pino. Do tune in for their fantastic and informative library of podcasts featuring numerous interviews with MMT economists and other experts. So now, without further delay, I'm delighted to present our guests, our associate member, Phil Armstrong, who is joined in conversation with one of the founding proponents of modern monetary theory, all the way from the Virgin Islands, Warren Mosler. So a very good warm welcome to you both. Thank you.
Thank you, Prue. I'm just waiting for Warren to appear on the screen. There he is.
Okay.
Just a little background before I ask Warren his first question. I first saw Warren on a video introducing Paul Davidson at a conference, and I thought this guy seems really amusing and would be interesting to talk to. So I managed to get in touch with Warren, and he's incredibly patient. He managed to teach me MMT over a period of about 2 years. So everything I know, I'll learn from Warren direct. Any mistakes, of course, remain all's my own. But the first question, Warren, it's from my conversations with you over the years, both in person and in various media. You see things differently to most people. And that's not just in economics, it's also with your engineering, with your boat design, etc. So you just see things that others miss. That's my view. I'm just interested, I'm sure the listeners, viewers are, when did you first see the MMT lens or the Mosler economics lens on the world that others were making a mistake? When did it come to you, if you like?
If you'd asked me that question in advance, I might have had a really nice, coherent 3-minute answer. So now I'm going to try to remember all this.
Yeah, it's a while ago.
But I know you wanted to trip me up, so here we go.
Yeah.
So it came to me as it became relevant. Mm-hmm. So I can remember being at Savings Bank of Manchester and somebody asking me about interest rates on loans and looking at different ways rates were calculated and present values, and particularly car dealers who were always trying to show rates maybe in a way that doesn't accurately reflect the rates people were paying, and regulations preventing that. So I started looking at, that was my first job, collecting delinquent loans at a savings bank in 1973. And they also had me go to all the car dealers to try and get them to use our bank, to do business with our bank. It was a very small savings bank. It had maybe $5 or $10 million of capital, so tiny bank. So anyway, so as things were thrown at me, I look at them to see. I look at things like, well, how does that work? What makes it work? Just as a kid, I would take apart a clock to see how it worked, or try and figure out how a light bulb worked, or anything else. So it's just a natural curiosity to see how things work, what's going on underneath, to make things function. And it started the very first time I got involved in the very first job I had, which was at a small savings bank.
And when you talk a lot about the Italian bond epiphany, shall we say? How did that sort of crystallize your thinking of it? What was this background of that story?
So I had generated a pretty good understanding of monetary operations before that, because I had worked at Bankers Trust. They were a primary dealer. I was on the money desk there, in derivatives, Ginnie Mae securities, sales and trading, options and futures and that type of thing. So I had a pretty good awareness of that going way back, but I had never had the motivation, or it was never presented to me, this last piece of the pie that became modern monetary theory. And that happened due to circumstances. Italian bonds were trading at approximately 12% in lira, and we could go borrow money. We could go borrow lira to pay for them at 10% with the same maturity, so there'd be no risk. We'd make a guaranteed profit of 2% in lira, and then whatever the profit was, we could sell it for dollars. But the risk was that Italy might default. And back then, there were a lot of prominent economists. One of them was Rudy Dornbush. I think he was MIT. Was going around the world explaining why Italy would default in these lengthy reports. And I was thinking, well, if we could come up with any reason why Italy might not default, then this would be a good position to have on for our investors. It would be a good investment. And so I started thinking about why they may or may not default. I never had any reason to think of why a country may or may not default before. Nobody had asked a question, and it didn't matter. But now it mattered. And so I started thinking about it. And the first answer I got when I talked to people, they say, well, I said, why hasn't any country defaulted with a floating exchange rate? And they said, well, it's because they can always print the money. I said, okay. But when I look back, no one had ever defaulted, and no one had ever just printed the money. So yes, they could do that, but that couldn't be the reason they don't default, because somebody would have done it by now. There's a better reason than that. And I was talking to a lot of different people, and at one point I remember talking to my research guy, Tom Schilke, and it dawned on me. I said, Tom, if we buy Treasury securities, which we did, we were clients. If we buy Treasury securities from the Treasury, or if we buy them from the Federal Reserve, it doesn't make any difference to us. All the money goes to the same place. We wire transfer the money to the same place. So we own the same thing, which was basically a time deposit at the Federal Reserve Bank. Okay, and so if it doesn't matter for us, anybody in the private sector, whether they buy securities from the Fed or the Treasury, then it can't matter to the economy because we are the economy. The only difference possible would be how they account for it on their side of the ledger, which is government accounting, which is just after the fact record keeping. So functionally, they have to be identical. Well, at that point in time, Treasury securities were there because presumably the Treasury was funding expenditures. The Fed was selling Treasury securities when they did to support interest rates to keep a reserve excess from causing the rate to fall. So I said, okay, well, it can't be both. It's got to be one or the other. And obviously, it's to support interest rates. It has nothing to do with funding expenditures. And so that was the reason there's no risk in these securities because, continuing the logic from that point, we all knew that the Fed can't do a reserve drain without doing a reserve add first, which means payments can't be made to the government unless the government pays you first, because all the funds to pay the taxes, all the funds to buy government bonds come from the government. The Fed credits your account, either doing repos or some manner through payments. And they have to credit your account before they can debit your account. Because if they debit it first, then you have an overdraft. And an overdraft is a loan from the Fed, which means they lent you the money first before they subtracted it. So either way, they have to do a reserve add in one form or another before they do a reserve trade. So the whole reason you don't have a default issue is because the market, at that point in time, had the sequence backwards. The market would include every congressman at the time. These were back in the Ross Perot days, when budget deficit was a big deal. And everybody in Congress thought that you had to get money through taxes to be able to spend. And what you did get, you had to then borrow from, it wasn't China back then, I think it was Japan or something, and leave the debt to the next generation, right? So we're just looking here, okay, well, they've got that sequence backwards, and that's why they're afraid of default. Where is the money going to come from? Because once you understand that the government spends first, which then supplies the economy, so to speak, with the funds to pay the tax or with the funds to buy the bonds, the whole idea of solvency doesn't make any sense. So that's why there's no default risk with these Italian bonds. Italy had their own currency. The lira was floating exchange rate. Italy is spending lira first. When you got deep down into Federal Reserve operations, they were crediting accounts first and then debiting them when the debt was sold to transfer the lira to a separate account at the Bank of Italy. And so the whole idea of default just is not applicable to the situation. Well, one of our clients was Harvard Management at the time, and they were running an endowment fund, and they wanted to buy these Italian bonds also. And I spoke with them, and that was Dave Middleman, Maurice Samuels, longtime clients. And they said, okay, good, we got it. But before we do this, let's go over and talk to those people to make sure. So I said, okay, well, they had the business card, said Harvard Management, they could set up the meetings. And they set up meetings at Treasury and a few other places in the Italian government. And I went over with Maurice, and we had meetings with various people. And the key meeting was with Professor Luigi Spaventa, who was at Treasury at the time. I think he was Treasury Secretary or Assistant Secretary. And we go in, and he's all dressed up in his three-piece suit, looking very much like Keynes with the pipe and all that, and expecting complaining, because that's all they ever got there, because people were complaining about not getting paid by Italy. People were waiting for withholding tax. And the reason they weren't getting paid is the people making withholding tax, there were only two of them. And one of them was pregnant, so she wasn't in the office, and the other one couldn't keep up with the work. And all these international people are coming in saying, where's our money? But it wasn't a solvency problem. They just had an administrative problem. So I said to him, Professor Spaventa, now don't answer this, it's just a rhetorical question, but why is Italy selling all these BTPs, CCTs, Italian bonds? Is it to get the lira to spend? Or is it because you spend first, and then if you don't sell, which adds reserves, lira reserves to the system, if you don't sell the CCTs or BTPs to do a reserve drain, then the overnight rate will fall to zero because it'll be an excess reserve position, and your policy rate is 12% or whatever it was, 10, 12%. And so to support this policy rate, you have to sell securities. He looks at me And he thinks for a minute or so, half a minute, and he says, no, the rate would not fall to zero. It would only fall to 0.5% because we pay 0.5% support rate on balances. I said, perfect. I've got a guy who understands monetary operations. I've been to a lot of central banks. Nobody at that level understood monetary operations. Well, I didn't have to say anything else. Within another 10 seconds, he jumps out of his seat. He goes into this rage about the IMF and how they were making them act pro-cyclical, and they had to have austerity and all that, otherwise they were going to default. And on his desk was this paper, I don't know, an inch thick, from Rudy Dornbush about why Italy was going to default. And we didn't have to say anything more. It was all doom and gloom over there. They were ready to default, I guess. And all of a sudden, it's a party. And we're supposed to be there 20 minutes. He starts inviting in people from the other ministers from the other rooms. And they got a big, huge cappuccino machine, and they start making us cappuccino. And everybody's like celebrating. 2 hours later, Maurice and I had to get out of there and go to our next meeting. But anyway, a week later, the announcement came out from the finance ministry: no extraordinary measures will be taken. All payments will be met on time. Because they realized they're just credit accounts, and there's absolutely nothing to be gained and a lot to be lost by not just doing that. And the crisis went away because it was never actually there. Much like our budget crisis today, right?
Yeah, that's a great story, Warren. I mean, I really enjoy it, and I can picture the scenes in the room. I love that story. I hope that people listening kind of can connect real events to your thinking and the way you told it.
So I was walking into the room at Treasury, the building. Yeah. They have these huge arches for to walk through. They must be 20 feet tall. Yeah. And as we're getting towards it, I go to Maurice and I go, duck your head. And he ducks down. Then he looks up. He just starts laughing. And he said that's so people could come in with their horses, with their spears. So, yeah.
Well, I suppose that under the gold standard, maybe there was some relevance to it. A bit like when people rode on horses with spears, there might have been, some relevance to the archers. I might be trying to make too clever an analogy.
Now, a few years ago, I was talking to somebody at the Bank of Italy, and I came up with a way they could save money. Why don't you send all the guards home? You don't have any money here anymore. What are they going to do? Come in and steal your Target 2 deficit? There's no gold. There's no money. I thought that was a good idea.
Well, I don't know. The Union of Guards would have liked it if there is such a thing. But I've got a few questions for you, so don't answer them all at once. So you got to try to summarize this. So some guy said to you, well, what would be the main differences in conceptualization of the economy from an MMTer, from a mainstreamer? Now, you can make an MMTer and a mainstream. You can categorize them in any way you like, and just like the basics. And then what I'll do is I'll try and develop what you say in the rest of the questions. So like a summary, how do you do it?
So if an economist says, we need deficit spending now, but because interest rates are low, the market is telling us it's a good time for the government to borrow. Wrong. Or right for the wrong reason, right?
Yeah.
Okay, so you get that kind of thing around the edges. Or, yes, the debt to GDP ratio is 85%, but, Japan's up to 200 and they're not having a problem. So it's probably okay to spend more public services or cut taxes or something like that. So those types of things show that this person does not understand monetary operations. They're out of paradigm. They're thinking of, whether they know it or not, a fixed exchange rate world like the gold standard that you talked about. And so whenever you hear that gold standard, fixed exchange rate rhetoric come into a conversation where there's a floating exchange rate policy, this person is out of paradigm.
This is not a question from me. It came in from one of the other members of the team. It could have even been Neil, who has been sending me a few questions. But sometimes, I mean, not to be rude, I like to laugh at mainstreamers. It's a hobby of mine, and maybe I ought to do it. But sometimes mainstreamers say to me, well, you don't understand mainstream economics. Well, I reckon I do. I thought it for 30 years. So what would be your sort of response to some, when you criticize mainstreamers, when they say, well, you just don't understand what we're doing, what would be your response? That's the question.
Usually I don't. My criticisms are, yes, you're correct, but that applies to a fixed exchange rate policy and not today's floating exchange rate. So they're normally correct in some contexts like that because their models all have assumptions in them, and so they don't do the maths wrong usually. Okay, so based on the assumptions in their model, the model's probably correct. So I don't take the approach that the model is wrong, that their forecasts are wrong. It's just that they might not apply to a world that's operating under a different set of assumptions than what they're using.
I kind of think mainstream economics is a bit like studying the biology of a unicorn. I mean, given the assumptions of what a unicorn is, it's really good. The only problem is that the unicorn doesn't actually exist. Well, as far as I know. So, and then when you try and apply it to the world of horses, there's a little bit of trouble. One thing I'm going to move on now, Warren, is you've got a great way of analysing monetary policy where the central bankers have it all backwards. And I absolutely love your analysis of that. Obviously, we wrote a paper together with all your original thinking and my name on it too. So many thanks for that, which is now gracing the website at GIMS. If you haven't read the paper with Warren and I on monetary policy, it's fantastic, honestly. Read it. So, Warren, I just wonder if you could explain what central bankers think about the relationship between interest rate changes and expansionary, contractionary policy changes and what it actually is.
Well, I've talked to a fair amount of them. And one in particular who is very good is the best at monetary operations is Charles Goodhart.
Yeah.
And we speak the same language. There's no issue there. And I talk about how the government's a net payer of interest. And so, therefore, when rates go up, it's a fiscal transfer into the economy, which I would think would support the economy. And he doesn't disagree with that. And on the other hand, you've got the differences in propensities to consume, propensities to spend interest income. So, in other words, in the economy itself, there's a rate where for every loan in a bank, there's a deposit. For every borrower, there's a lender. Does a cut in interest rates cause the borrowers to spend more than the savers cut back? It causes the saver to cut back because he's lost some interest. The borrower saves some money, so he's gained some money. Is the borrower more of a factor than the saver? And they call that the differences in the propensities to spend out of interest income. And he'll say, look, I think those factors are strong in current markets that, that effect you're talking about through the interest income channel might not be enough to do what you think it does. And I'll agree. I'll say, look, I suspect it does with debt to GDP ratios at 100%. We're talking about differences that net interest income added, even though it goes to interest income, generally has a fairly low as you consume, relatively low, then it seems to me it's got to be overwhelming. And as debt to GDP gets higher, it's got to be larger and larger. And so, we don't really have a disagreement in principle about how it all works. He just thinks that the lowering rates is still overall an expansionary bias and raising rates is contractionary, deflationary, where I think it's the opposite. And I don't have the tools to do all the econometrics, and that was, we first started talking about this probably 1995. So it's at 25 years ago. And back then, there was all this talk about Japan and zero rates, certainly in the late 90s, was going to be an inflationary thing. And they just started doing quantitative easing and currency depreciation, inflation. And it's like, well, we'll see. So now 30 years on, Japan still is trying to create inflation. They failed to create inflation. Central bank tried everything it has, been trying as hard as it can and failed. The European Central Bank has tried as hard as it can and failed to create inflation with negative rates and whatnot. And the Fed tried as hard as it can and was failing. It then raised rates a little bit. Inflation went up a little bit. I'm not sure it could be the cause, right? It's based on my bias. And now when they brought rates back down again, inflation's come back down again. Now I know there's COVID and there's other things going on, but through all these backgrounds, you go across a lot of different countries in the world. And when they cut their rates, the inflation's coming down. Look at how low the inflation rate is in Brazil. Look at how low their interest rate is. And I can't prove causation. I can't say they brought the rate down because inflation was coming down anyway. they can't say the lower rate didn't bring inflation down, any more than I can. But now I've got 30 years of data, let's say 25 years of data, pretty hard data, that certainly doesn't contradict what I'm saying. I think it entirely reinforces it. And then I started thinking about another channel, which I've also thought about for a while, which is the forward pricing channels, which fits the academic definition of inflation, and where the policy rate is the rate of inflation as an academic would define it, not necessarily as a central banker or congressman, but as an academic would define it. And it all keeps pointing to the same answer, that when you raise rates, you're causing inflation through different channels, and you're causing the economy to expand, aggregate demand to go up and not down. Through a peculiar channel, you're paying interest to people who already have money. You hear this basic income argument out there. Should we have it? Should we not have it? Well, a positive rate of interest is basic income for people who already have money. If you have money, you get more money for free. There's no supply side. It's just on the demand side. And with all the talk I've heard about UBI, basic income, I've never heard anybody recommend that we give it only to people who have money in the bank. So I don't think anybody would support that as a way to spur growth. I certainly don't. It's like probably near my last choice of how to get the economy to grow. I'd much rather have an increase in public services or an investment or a decrease in taxes than decide to just increase government deficit spending by giving it to people who already have money. I mean, that's just doesn't make any sense to me at all. Okay, so other central bankers, the people in monetary operations like Vince Reinhardt, who I knew pretty well, spoke at some of our conferences, helped me write some of my speeches. I mean, this guy really understands monetary operations, and certainly even more detail than I do. He was Greenspan's right-hand man for 10 years. He was head of monetary affairs. He was with Bernanke, Greenspan and then Bernanke. And he understands it exactly. Now, he doesn't talk about it, but he certainly understands it. And the other people I talked to at the Fed and the Treasury, they all seem to understand it. A friend of mine was visiting Treasury a few years ago, talking to somebody pretty frankly, and he asked one of the officers, and he asked him if he'd read my book. And the answer was, well, yes, but don't tell anybody. So now I'm somewhere I'm up there with Marx now, right? Where people in government, if they've read your book, don't want you to tell anybody.
Well, I guess if you were say you were the court astrologer to the Duke of Parma or somebody, when when Galileo was out there, and you might be thinking, well, I quite like the sound of this Galileo chap. He's right, but I ain't going to say anything because I've got a nice cushy job being the astrologer of the Duke of Parma, and I'm making a lot for it. So I think there's an old cliche. It's hard to do something when your salary.
You know what? I don't see that with these Fed people. They're very nice. They're sincere. It's just not what they do.
Right.
They're like quiet academics that were brought in. They're not flashy or anything. They work hard. Yeah. When I asked the guys who do they do the econometrics to try and detect the differences in propensity to consume out of interest income. They say, look, we think that it's stronger on the borrower's side than the saver, but because I can't detect it in the econometrics. He's been there for 20 years.
Yeah.
So if those propensities are that close, the interest has to overwhelm that. Okay, because that's not close. I mean, it's just a question whether the other one's larger.
I think
they do have it backward. Yeah. So anyway, just to conclude the first question, which was, yes, they do have the interest rate thing backwards.
Yeah.
Okay. Raising rates is inflationary. It is expansionary. To me, all the data shows it. And the reverse is true. Lowering rates like they've done is contractionary and deflationary. And so they're trying to create inflation. They lower rates. The inflation doesn't go back. It gets worse. And so then they lower rates again and the inflation's even lower. And I've used the analogy of a carpenter with a piece of wood. Where no matter how much I cut off, it's still too short. You're still doing that today, right?
Yeah. What I think is interesting and will be interesting maybe for the people listening in is obviously you've created this idea of the guys on the shop floor, the professionals, they know what they're doing, they're not flashy guys. But I think you use the phrase, the appointees at the top, they don't get it. So in a sense, you just so we're not saying it's a conspiracy theory. And so where does the break come between the guys who are doing it, who really kind of get it, and the guys, the appointees, if you like, the ones that don't? What's your experience with this?
I used to ask Vince that, and I'd say, Vince, how many people at the Federal Open Market Committee, I think it's 30 of them, understand monetary operations, like how the checks clear? He goes, 0. Because that's our biggest problem here, trying to explain it to these people. They all bring in their own ideas about how things work, and none of them actually know. That included Chairman Bernanke at the time. He did not know monetary operations. He didn't know how it worked. And he's certainly a nice guy and well-meaning, good American, whatever. Yeah. No conspiracy or anything. He's not. He's got his heart's in the right place. But same thing with Janet Yellen. They just don't understand basic monetary operations. You know why she was replaced, by the way?
No, I don't know that.
It was right there, public information. President Trump didn't think she was tall enough. Didn't look like a Fed chairman. So he wanted somebody taller. Ironically, she was the biggest dove on interest rates. And so the taller person he did replace her with, was more hawkish on interest rates, and they got in a big fight. So if he'd wanted low rates, he would have left her there. But he wasn't tall enough.
It's just like, I can't script it. It's crazy.
Well, he said he goes to central casting for his appointees. He wants them to look the part. That's how he does it.
Didn't you tell, isn't there a story that's about Larry Summers? I think it was Larry Summers who you had a word with, or someone who said he didn't understand reserve accounting.
That was in my book, and it's more accurate probably in the book, because I haven't read the book in 10 years. But
well, you can read your own books, would you? I mean, leave that to others. But
so I might if I get it wrong, correct me. But I said something like, Larry, what's wrong with the deficit? He says, well, it takes away savings that could be used for investment. So I go no, it doesn't. All it does is offset operating factors at the Fed. It doesn't have anything to do with savings or investment. He says, well, I don't really understand reserve accounting, so I can't discuss it at that level. And I had head of the Senate, Tom Daschle, was sitting next to me. He'd set up the meeting. He's just kind of rolling his eyes, looking at Summers like, what do you mean you don't understand this?
Yeah, well, it is funny. I mean, these things are comical, and people often the sense of all these guys know they're just sort of plotting against us behind closed doors, but the reality is nothing like that. I mean, as you say, they don't really get it, or some people do, but they're not necessarily the people who we think would get it. Well, Warren, I might follow up. Now, one of the things that you talk about, I think it's very, very interesting and very different. And just to whet the listener's appetite, I've managed to twist Warren's arm again to write another paper with this sort of comprehensive school teacher from England. And we're writing on inflation and the Weimar Republic, It will be appearing soon, I hope, on GIMS if the girls want it. And if Warren's name's on it, I'm sure they will. Now, one of the things is I'm keen on putting an MMT lens, if you want, on Weimar. But initially, what I persuaded Warren to do, just to explain to everyone, is have a look at my long-winded waffle on inflation, edit it down, which he's been doing. But the way that you define inflation and discuss its causes, going back to that very first point I made about how you see things differently, I think it's got, even compared to many of the MMT community, I think, how you kind of pinpoint the origin, the nature of inflation, what it is, what causes it. It's quite different. I think the listeners will be very eager to hear what you think about this inflation question.
Well, first of all, I just emailed you that I got through the whole thing.
Oh, I've seen now. That is great.
So now you got a draft to start cleaning up, but at least I think it's organized coherently. Some of the points where you had long explanations for, I cut down because they weren't that relevant to what the paper says now. They were relevant to what the paper said that you had produced, but we kind of changed the voice of the paper, and they were speaking to a different point. I'm not sure I cut enough, so we'll see.
Yeah, we'll play that. We want
to cut as much as possible. So what happened in 1992 or whenever the Italian thing happened, the idea that the funds to pay taxes by bonds comes from the government, what I realized at the time is it's just a simple monopoly, and it couldn't be simpler, any more than a bus token for a bus company. It's just a simple thing. And so that meant the price level, monopolists are price setter. Now you taught some micro, right?
Yeah.
So first thing you teach is monopoly, right? Okay, so how long does that take you?
If I just want to do it briefly, I can do it in 5 minutes. But I mean,
Yeah. Okay, so let's say an introductory course, introductory micro. Yeah. Introductory micro, first year students,
Yeah.
What do you spend? 10 half-hour on Monopoly, maybe?
Yeah.
Then you go on to oligopoly, right? How long does that take? A little longer.
Yeah.
Maybe 2 hours or something.
Yeah.
Okay, then you go on to then you get into competition. More than oligopoly, and that takes the rest of your life, right?
Seemingly, yes.
Yeah, and then you have to learn what an asymptote is and all that fancy math, right? Yeah. Okay, but not with Monopoly. Monopoly is you got it, they want it, you set the price, you let them set the price, you still have to agree to it, you're still price setter. There's no way around it because there's no competition. Okay. The good news is the money is the easy one. The currency is the easy one. It's the monopoly. And the government's got what the economy needs. There's a government, our money story begins with a tax liability, where the government levies a tax. Why? What's the government trying to do? It's trying to provision itself. It needs soldiers and public health workers and economics teachers. And so how does it do it? Well, it imposes a tax liability. That's what underpins the whole system. Tax liabilities come first, not tax collection. Remember, everybody else thought it was tax collection, but it's not. It's tax liability. Tax collection comes last. Okay, so first is a tax liability. That creates people who suddenly need those funds to be able to pay the tax. So they are now what we call unemployed. So the tax liability creates unemployment. And in fact, it's the only source of unemployment if you drill down enough here. So the government creates unemployment by imposing a tax liability. Why? So now it can hire those people to become economics professors and soldiers and legal assistants. By spending its, what I say is otherwise worthless currency. So now it can do that, which it then does. So first the tax liability, then people show up, all right, what do I have to do to get the money? Government says, be a soldier, I'll give you $50,000 a year. They say, fine. They come in, they get their $50,000, they take their money, and they pay their tax, which is going to be less than that. But then the economy pays taxes back to the government. And so taxes get paid as the last thing. Okay, and that's why it's called a tax return, because you're returning the revenues. Revenue is the word return in French or Latin, or one of those languages I didn't study. Okay, and so it's render unto Caesar what is Caesar's. Returning to the government what came from the government. Yeah. Okay, so it's a monopoly. And so the value of that thing is whatever the government tells you have to do to get it. Okay, so do I have time to review this Pompeii anecdote? Yeah,
you
wife
do.
And I we're visiting. Because I just saw another article on that somewhere which confirmed the whole thing. So we were in Pompeii on one of those, we dropped in and jumped on one of those tours, and they showed us the coins, and he held up these little coins. He said these were found in the ashes of what would have been somebody's pocket, or what would have been a cash register, or would have been under a mattress, or just in the street. And Pompeii was a very nice place to live because we had good public services. Because yes, taxes were high. They would collect these coins for taxes, and then they would pay people for sanitation and for public safety and construction and all that. So you know me, I'm a bit of a troublemaker. So I said to the guide, I said, well, actually they would pay the people first and then they would collect the coins. He goes, no. You collect taxes, you get the coins, and then you pay the people. So I said, well, where'd the coins come from? He says, well, the government made them. And they were like copper coins. They weren't like expensive coins. And by the way, they were only found within 50 miles of Pompeii. They were not found anywhere else. He says the government made them. I said, well, then how did anybody get a coin to pay the tax? He says, so they spend them first and then they pay the tax. I said, yeah, how else can it work? He grabs his head like this. He goes, no. And he went away. And he wouldn't talk to me for the rest of the tour. Okay.
You spoiled it for him.
Yeah. He's been a guide for 20 years. So look, I guarantee you 2,000 years ago, everybody in Pompeii knew that they put a tax liability on your house or something, resident tax or something. Population owed tax. Some people showed up for work. They get paid. They buy things from other people. Everybody could pay their tax, and the coins would get returned to Pompeii that they spent first and then collected the tax. Now, the archaeologists have found, last I saw, 20,000 coins in the street. So how did they get there? Well, the government must have spent more than they collected. That's the budget deficit, right? Yeah. They spent 100,000 and they only collected 80,000 for tax. People earned extra coins so they could have a money supply for savings, for to be able to make change at the store. They spent more than they collected. And what are those coins in the street? Those are the public debt. Okay, so when you look at the sequence correctly, public debt are the coins that were paid out and spent. Some were used to pay as taxes, some stayed in the street. Public debt are the coins that were spent but not yet used to pay tax. Theoretically, today, if they ever restarted, you could pay your tax with those coins, but it all expired, a couple thousand years ago. But that's what they are. Okay, so the public debt today is nothing more than the pounds spent by the government that haven't yet been used to pay taxes, and they're sitting there in the street. Today, the street is bank accounts. So they're in reserve accounts at the Bank of England. They're in securities accounts called gilts or whatever they call them. That's the public debt. So how do you pay it back? If you ask somebody in Pompeii, all those coins in the street, that's the public debt. How do you pay it back? They go like, what are you talking about? The question's not applicable. And so today you've got pounds that were spent by the government. They get credited to account A at the Bank of England called the reserve account. Then they offer account B, which are securities accounts, time deposits. And so people decide they want to move their money from a account A to account B, from a checking account to a savings account. That's all it really is. Same as any commercial bank. And that's called going into debt. Account B, the time deposit, is the debt. Account A is not. Okay. It's it's definition. It's arbitrary. Call it whatever you want. It's not wrong. It's just a definition. And so what happens when the bonds mature and they have to be paid back? The central bank, the Bank of England, debits the securities account and credits the reserve account. They shift the balance. They're both just pound balances, in account A, and pound balances in account B. Well, when they mature, they subtract the pound balance. They make the pound balance in account B smaller and make the balance in account A larger. There are no grandchildren and no taxpayers in the room. It's not paying it back. It's transferring it back. Yeah. Selling the securities transfers funds from account A to account B. Maturities, paying it back, transfers it from account B back to account A, all on the books of the Bank of England. It's not any kind of a financial event of any consequence that anybody would care about.
And so, this thing you say, Warren, about how if the price level goes up, it's necessary.
Oh, yeah. So we're talking about the price level. Yeah.
Yeah. The function of, governments paying higher prices, I think is very interesting. So in other words, the government. So let's go back to Pompeii. Yeah. So what's the coin worth? Yeah.
Okay. So let's say you become a police officer and they pay you 1 coin a day. Mm-hmm. And maybe your tax is 5 coins a month or something. So you have extra money to spend on your life. And you're going to be working full time. You didn't have to, but you want to work full time because you don't want to make pizza and you don't want to raise cattle or do whatever every other person does. They don't want to be police officers. They'd rather you go out and make your 30 coins and then you can go out and buy the stuff from them. And then everybody will have their 5 coins to pay their tax. Okay, so you go out and work. So what's a coin worth? Well, let's say you got somebody raising chickens and you want to or making pizza and you want to buy pizza. Well, how does the market decide what a coin's worth? Well, the coin is worth a day's work. And so you get these, what do you call it? A dual something of wants or something? You're the economist.
Yeah, double coincidence of wants.
Double coincidence of wants. That's it. I couldn't think of it.
Yeah.
So you get this double coincidence of wants. And it turns out that this guy can make so many pizzas a day. And, he'll do, 1 coin for him. He doesn't have to work a day. He's willing to give you 10 pizzas for the coin. And that's the market price. Mm-hmm. And so that price is based on what you have to do to get the money from the government. So he gets paid a coin and he could buy 10 pizzas. But let's say the government said, you know what? I'm going to pay you 2 coins a day instead of 1 coin. Now what's the price of a pizza? I mean, how many pizzas do you get for 1 coin? You only get 5 pizzas, right?
Yeah.
Because you can earn a pizza in a half a day. Guy's not going to give you 10. If he had to give you 10 pizzas for a coin, he'd go work and be a police officer. Your double coincidence of wants gives you a relative value. In terms of days' work is 10 pizzas. So now they're paying 2 coins, so a half. Okay, so the coin is worth what the government says you have to do to get it. Okay, if they say you have to work a week, 5 days to earn 1 coin, now a coin's worth 50 pizzas. Right? So the government paying more for the same thing, all it does is redefine the value of the coin lower. Oh, we're going to give everybody a raise, let's pay them 2 coins. Well, all of a sudden the coin's worth half as much, and you only buy, 5 pizzas with a coin. That's inflation. That's a change. Well, that's not even inflation. Inflation is a continuous change in the price level. That's a one-time change in the price level. To have inflation, the government has to do that continuously.
Right.
We'll pay you 1 coin a day. We'll pay you 2 coins a day. We'll pay you 5 coins a day. We'll pay you 1 coin an hour for 8 hours. We'll pay you 2 coins an hour. The continuous increase in the price level comes only from a continuous exchange with government where the government's paying more for the same thing. As a point of logic, there's no other source of the price level. And MMT is the only school of thought in today's world that understands that. I mean, 150 years ago, maybe everybody understood it. In Pompeii, everybody knew it. It was perfectly obvious. But it's been lost. And right now, that's one of our main contributions to the understanding of economics that the other economic schools of thought absolutely don't understand. They've got inflation expectations and all this other nonsense. And they've totally missed the idea that it's a monopoly. It's economics 101, the easiest kind. It takes 15 minutes to teach it. Monopolist is price setter. Now, the thing is, even the other MMT proponents don't emphasize this. And it's one of our lead contributions to the world. And they'll talk about, well, you won't create inflation until you run out of capacity. And then if you try to spend more than what you have, it's not what we're saying. I mean, it's not wrong. What we're saying is the government goes to buy things. If it's paying the same price, you're not creating inflation. If suddenly they're offered to you at a higher price and you buy it as a government, now you're redefining your currency downward the same way that Pompeii paid more for the wage. And you're changing the price level. Okay, because in a market economy, in theory, you only have to change one price and then everything else is relative value. Not that that holds up 100%. There's all kinds of institutional structure in there that has, frictions and whatnot. But conceptually, that's what's going on. Yeah. And so it's not when you run out of capacity. It's when when the market presents you with higher prices. If you decide to pay those higher prices, then you have redefined your currency down. It used to be called crying down the value of the coin. Yeah. So we know that, but you're not going. I don't know. Do you hear that a lot out of MMT proponents? Not much. A little bit around the edges.
Not much. I mean,
they don't lead with it. They don't lead with it, right?
I think it's probably a bit quote unquote out there. I think one of the things is that they have a lot of MMTers have such a lot of time getting over this. Tax liability comes first and tax collection comes last. That when they hit people with the inflation is because the government's paying a higher price than previously. I think that they think, whoa, I'm not going to risk that yet.
Right.
I mean, as a point of logic, to me, it is absolutely certain.
So what happened is
maybe back off it a bit because I think it's quite tricky to get across.
So what happened in Weimar to cause prices to go up? The government paid higher prices.
Yeah.
Okay.
And now the paper's out there. They can all enjoy it. Now, Warren, I've got to press on a bit because there's a lot of other questions I've got on my list. I mean, I could talk about inflation for another half hour. But then people won't bother reading our papers because we've given them the answers. So we've whetted their appetite, haven't we? They're all waiting for it to emerge. But the one thing, as a question, now it was sent to me, I think, from a viewer. So I'm trying to paraphrase it, and apologies to the person who sent it if I don't say it correctly. From what I gather, someone has said, like Warren says, unemployment is always a monetary phenomenon. But what about, say, a guy who's prepared to work for, say, I don't know, chickens? So if some guy's prepared to pay him in chickens, and so he could be unemployed if the guy who was paying him in chickens refuses to do so. How would you kind of fit that into the overall idea that unemployment is always a monetary phenomenon?
Unemployment, as we define
it, to the person putting the question forward.
That's how we define it. We define it as people looking for paid work. Right. If it's somebody looking to volunteer for the American Cancer Society, we don't consider that person unemployed. And if somebody here wants to work for chicken, that's fine, and he's going around looking for a job that pays chicken, it's really not applicable. But what we would do is impute the value of a chicken and say he's actually looking for the $10 that a chicken costs because he He wants to trade it rather than get the money because he's trying to avoid taxes. So you have to use it when you have taxation. You have to use imputed value, otherwise it's too much. There's too much just tax evasion.
Right. Well, thanks for that, and I hope the originator of the question won't be too hard on me if I got the wording wrong. Now, Warren, here's another point. Wait
a minute. Let me finish that answer.
Sorry.
Look, in a barter type of economy or in a non-monetary economy, you do not get unemployment. When you went to the American Indians or to Africa before the Europeans came in, where they didn't have monetary, they did not have unemployment. You went into a village, everybody was doing something. The grandmother was taking care of the kids, the wife was doing this, the husband was doing his stuff. And if they came up with a labor-saving device, they didn't have people out of work. They just had other things they did. Yeah. And it's not that they didn't have leisure, but they didn't have people who were considered unemployed looking for jobs that couldn't do it. Okay, it only happens in a monetary society, and that's the reason. Because a monetary society begins with coercive taxation, and that's the beginning of unemployment as we define it today. We didn't have Marx's mass unemployment before there was a monetary system. Yeah, that absolutely makes sense to me. Yeah, okay. The point what I was going to come on to next, if I always think that, this idea that, the government has to spend all in before it can tax or borrow is a very powerful idea. We draw people in. Yeah. Obviously, your nuanced and logical position on inflation is difficult to explain, but nevertheless, I think the logic is inescapable. Now, the other big area I know MMTers find hard to explain, and there are, in my opinion, people who are under the I'm not to be impolite, kind of under the MMT umbrella when it suits them, shall we say. Yeah. Don't buy into MMT's idea that, exports are a real cost and imports are a real gain. To me, this is another thing that MMTers who find it difficult to explain. So, in a sense, imagine you're advising an MMT activist. How would you deal with that trade question? I'm sure you've come across it many times. You know the people I'm talking about who don't try to go off at a tangent with it. Off-piste, shall we say? Yeah. Well, it's going to be even more difficult when they try and explain my understanding of quantum mechanics. We won't bring that one this one. We'll have to write a paper on that. But you'll be on your own, I can't help. I'll write the title. So the good news is we're still at the easy stuff. Yeah. All right, but yes, it's chapter 5 in the book. Okay. Most of them haven't read it, but no. What it is there's a sequence to explaining it. Yeah. And the sequence I use is to first explain what is real wealth. So real wealth, I call your pile of stuff. Yeah. So your pile of stuff is everything you can build domestically. All your domestic output makes your pile of stuff larger. Yeah. Okay. And the more people you have working domestically, the larger that pile of stuff. Okay. Imports makes the pile larger. Exports makes the pile smaller. So you want to optimize your real wealth. So you want your pile of stuff to be as high as possible. So that means you want to produce everything you can domestically. Sustaining full employment is a big thing because that's usually more of a factor than imports and exports. Okay, and those give you your, like you say, chips to trade for. That's where the exports come from. It's part of your domestic production. Okay, so it's everything there, and then you try to add to that as many net imports as possible. In other words, for everything you export, that's your cost of your import. You've got to go from you to them, then you import, and you try and that's called optimizing your real terms of trade, is making your pile as large as possible. And then I just throw in the idea. You can always sometimes, I say always, but I like to use the extremes. So everybody thinks exports are so great, right? So what would happen if you exported everything and didn't import anything? Well, then everybody dies. You have no food, you have no clothes, you have no fuel. You've exported everything. Yeah. You're all dead, right? So let's say you import everything and don't export anything. Well, now you're all doing pretty well. You got everything and you don't have to work. Yeah. So from, in real terms, when you take a look at it that way, you can see that, the exports are the cost and the imports are the benefit. Yeah. And the other little quip I use is that it's the opposite of religion.
Yeah.
Economics is the opposite of religion. It's better to receive than to give. Okay.
Yeah,
so
sounds good to me.
Yeah. So from there, I say, okay, what's the problem? And then they come up with all these. The first thing they say is, well, what you don't understand because you're an American is that you can't do that if you have a small open economy. So for 30 years, the first thing anybody says to me about anything I say is, well, what you don't understand is, it's like, okay. Yeah. Not like I haven't been through this with a lot of people.
I've been going through thing.
Let me add this. Look, I've been going through this for a long time.
Yeah.
The one thing I've been hoping for this whole time is that somebody will just tell me I'm wrong, where I can understand that, and I can give it up and get a life doing something else.
Yeah.
I'm still trying to do that. So if you've got something, I'm on your side. I'm on your side. Tell me I'm wrong.
Yeah. You've convinced me. I'm not going to be the man to do that. Yeah.
All right.
Yeah. The other thing they do on the related point, Warren, is you know where I'm going with this. So you talk about trade and everything else, then there's a sort of hush, and some guy will go, oh, but what about the exchange rate? It'll crash, it'll tank, we won't buy anything. Now, obviously, my view is it's not going to happen, and my view is MMT's going to work, so that the traders are going to buy your currency once to see how good it is, and they're going to go up. But how would you?
Okay,
these dooms.
So I was in Italy, and I gave like 45 presentations in 60 days, or something like that. Different universities, different economics groups, and that question always came up. So I actually have a pretty good answer after that much practice.
Yeah.
So say, look, if you take a Ferrari and you drive it to Berlin, it'll trade for maybe 4 Mercedes. At the time, the Ferrari might have been 200,000 euros and the Mercedes were 50,000 euros each. Okay, and those are your real terms of trade. One Ferrari's going to exchange for 4 Mercedes. Okay, and it doesn't matter where the lira is, where your currency is, or even if you have a currency. The guy in Berlin really doesn't care. He's just taking what we call the world price, real terms of exchange, trade for the Ferrari versus the Mercedes, and giving you the cars. And you say to him, yeah, but the lira is up 20% or down 20%, so it's not going to change that ratio. Okay, that is what they trade at. In South Africa, they go out and mine a gold coin, and they go to London, exchanges for a man's suit. That's what I used to hear historically. I mean, they don't really care what the level of the rand is, or if there is a rand, or who built it, or it doesn't matter. Okay, but what the currency matters for is who has to dig the gold and who gets to wear the suit. It affects the distribution in the country. Who has to build a Ferrari and who gets to drive the Mercedes? That's what the level of the currency does. Those are internal distributive matters, and that is determined by the rest of the institutional structure, and it's continuously changed with legislative change, with tax change. So that's all under direct control of the Italy or under South Africa. They're controlling the distribution within the country. So what I'm saying is the level of the currency doesn't change your real wealth. Keep everybody working through full employment policy. You're going to produce a certain number of gold, a certain amount of gold. You're going to get a certain amount of men's suits. That's not going to change by the level of the currency. It's a distribution. So if you've got a poor outcome of trade, people are losing work, losing jobs, and this is happening and that's happening. To address it, it's a distributional issue, okay? It's a fiscal issue. It's a financial issue. You can always sustain full employment just by, fiscal adjustments. There's no way you don't have to have full employment. You can keep full employment. It makes no sense to say, because of this trade issue, currency, this, that, and the other, we're only going to have 90% of our people employed instead of 100 to fix this other problem. It's not what you do to fix that problem. You stay fully employed, maintain your maximum domestic output, which are your chits that you trade for your imports, and deal with your problem in a way that makes sense to deal with it. You don't shoot yourself in the foot because your checking account won't balance. Now you've got to deal with a foot with a bullet hole, right? So you still keep yourself healthy to deal with these external problems.
And what these guys, sorry, a lot of these
go ahead.
Talk about speculators, they'll say, oh, well, I see what you mean, like these fundamental forces. What about these sort of bad guys in suits in the city, are all just sell your currency? Won't that sort of bottom it out, So that's right, in your face, very immediate. How would you deal with that sort of point?
Well, number one, the change in the value of the currency doesn't affect the real wealth of the country. Right. Has distributed effects. Now, the euro not too long ago went from like 145 to 100. And I didn't hear anybody complaining or anything. In fact, they were being criticized for taking unfair advantage.
True.
Okay. The yen went from 80 to 120 not too long ago in a month or two or something. I don't know. Short order, 50% collapse in the value. And nobody's, the Japanese are like manipulating. They shouldn't be allowed to do that. And what's the biggest argument with China? Their currency is too strong, right? So the U.S. dollar has been all over the place, massive moves, right? So these currencies move all the time. One thing they've discovered is now with today's economies, they don't alter the rate of inflation by enough for people to sort of notice. I mean, imports go up, and I would say in some countries they will, and it's not. I'm not trying to trivialize the fact that they can. It is can be a major contributor to inflation, but the currencies fluctuate, and you've got speculators in there. And if you don't want speculation in your currency, there's ways to do that. If you look at the source of the speculation, for example, one of my proposals for banking is that the regulation should not allow banks to make loans where they accept financial assets as collateral. If you want to buy stock, you can't go to a bank with those shares of stock and borrow money to pay for it. You just use your own money or whatever. And if you're the stock exchange and somebody wants to buy on margin, fine, but it better be your own capital because the bank's not going to fund that for you. Okay, that would go a ways towards avoiding some of the speculation, and some of it's in the foreign exchange markets. Okay. Also, you can use a financial transactions tax not to raise money, but to reduce speculation, to discourage the activity. That's what a transactions tax does. And if you have particularly you get international coordination that they want to reduce speculation and reduce transactions because it's a waste of human endeavor, then you could do a financial transactions tax. And you can also do it unilaterally if you wanted to have that outcome. And I'm not saying you would necessarily want that outcome, but if that's an important outcome. The Australian dollar went from 105 to 50-something, not the last few years. Now it's back to 70.
Yeah.
There's some major outcry in Australia about, look, we told you we got to join the euro because look what happened to our currency. No. Right. So I guess what is the point of the questions? Are they complaining about something? Are they answering the question that nobody's asking? And what's the trade balance between New Jersey and Connecticut? Well, nobody knows. But I guarantee you, if you publish that number, there'd be a big uproar and somebody would do something about it and create a real problem.
Yeah, I agree, absolutely. I mean, on one hand, if the currency goes down, it's bad, but apparently if it goes up, it's bad. So angle, really, I guess. I'm keeping a little bit of an eye on the clock because I've got a couple of, I've got like three particular questions I'd like to ask. I probably can't get through everything, but there's one from Neil, and his question is like, you've got countries like Argentina, Zimbabwe, they've got their own currency, but they've been in crisis. How would, they've had inflation problems. What advice would you have to these types of countries? What should they do? I would say if you want the UK to go that route, I could give you policies so you could do the same if that's what you're asking. Yeah, absolutely. You just tell me what you're thinking.
So each one has different specifics. I know Argentina, last I saw, they had a 35% policy rate. But to me, that's obviously driving the inflation rate, driving the currency down.
Yeah.
Can you imagine if Pompeii with those coins decided to pay 35% interest on any coins in the street?
Yeah.
What would that do to their ability to run the place? If they'd wind up paying people more, everything would have, they'd be flooding the place with money. It would be highly inflationary. It would be, it's fiscal spending. And so they do that. And they also have, so I've been told, I don't have any direct experience, massive what is commonly called a corruption problem.
Yeah.
Particularly through state-owned enterprises, through the banking system, where insiders get access to lending that there's no intention long-term to pay back, but they use it. They sell the currency for foreign exchange and drive the foreign exchange value down, which causes imports to go up, which things are then indexed to. Yeah. And then they've got all kinds of indexation of government wages and everything else, which is the government paying more for the same thing, causing inflation. Now, I'm not saying it's not good policy. There's plenty of economic study that shows that. The last one I saw studied inflation rates up to 40% and showed that higher inflation rates not only did not impede growth in the real standard of living, but actually may have promoted it. And so people don't like it. It's the government stealing from you and all that. They've got all the rhetoric behind why they don't like inflation. And so politically, it's political suicide to promote higher inflation. But from an economist's point of view, it's not an economic negative. It's just a numeraire. So
yeah,
I'm not directly answering your question, but these people have policies and procedures in place that promote what's going on, and there are massive vested interests generally go under the guise of exporters, where it's in their interest to do this. Their interest is to suppress domestic demand, to have as cheap a labor as possible, and they don't care what the level of the currency is. They're just looking for their real terms of trade, and if their real costs are lower through inflation, then they benefit by doing this. Now, I've said, to throw out for thought, that today's exporters are Marxist capitalists.
Right. Okay.
Okay. Because the exporters have no interest in the well-being of the domestic economy or domestic demand. In fact, they want it to be lower. But domestic businesses, like the U.S. used to have, with the auto companies before we had competition, they didn't care if they'd all get together, give the unions whatever raise they want, and increase prices, because those are the people buying their cars. And the whole country was kind of indexed. And so as long as domestic demand was going up, as long as their competitors were in the same boat with costs, they really didn't mind having a larger share going to labor, because it was good for them. Okay, but for the exporter, he just wants to get his inputs as cheaply as possible, as low real cost as possible. And so he has absolutely no interest in the well-being of the domestic economy. In fact, the worse it is, the better off he is. So he should not even have a seat at the table for national economic discussion, because his interests are counter to everybody. Now, under Obama, President Obama said, look, the problem with the country is we consume too much and don't export enough. We have to export more and consume less. Okay, backwards already, counterproductive. Yeah. And then who does he appoint as his chief economic advisor? Jeff Immelt, who is head of General Electric, who is the largest exporter. That's what happens when you put exporters in control. And the exporters are clearly in control in the major exporting countries like China and Japan, Korea. They all get, praised by all the rest of the world's leaders as doing the right thing and whatnot. They're just suppressing domestic standard of living for their own, it's their own benefit at the expense of the macro population.
It's another one of your seeing things differently. So what are heroes are in fact zeros, Warren, if I say the pun. Now, I'm going to be imaginative now. I'm going to be creative. Yeah. Okay, so say, it's very unlikely, but say we got rid of Boris and all the bumblers over in Britain, and we had a progressive, open-minded government. So I
thought Yeltsin was already gone.
Well, maybe you get him back. I don't know. A guy who didn't really get economics, but was open-minded and progressive, and invited you in, and you could have a team around you and said, right, now with the COVID problem and post-COVID, let's assume there's a new post-COVID world. And he said, right, Warren, you're in charge. Whatever you tell us to do, you're going to do. All right. Okay. In simple terms, what would be like maybe your top 2 or 3 priorities that you would tell in Britain now and post-COVID? What would you like to see us do differently at the economic level?
Well, look, the first thing you do is you set up the Swiss bank accounts, and then you conduct policy to make sure you fill them up as much as you can before you get voted out. So I'm not sure I'd be any different.
Fair enough. Yeah.
Am I missing something here?
Yeah.
Okay. So if I was,
yeah, if I ruled the world, or at least Britain, no.
Yeah. Yeah. So, first of all, we have to establish where we want to be in 4 years or 2 years or 5 years, and then figure out how to get from here to there. So what are the goals? What are we trying to accomplish here? What are we trying to do? So I don't know the details there as well as I do here, but the first thing I would say is, look, because I give a little bit of priority on this. We have eliminated emissions by or let's say environmental degradation, but I've seen numbers up to 40% by eliminating non-essentials.
Yeah.
Okay, so these are non-essentials. It's not by eliminating something we desperately need. These are non-essentials. We're sitting here with 20 million unemployed and nobody's lacking for any essentials.
Yeah. Okay,
now they might be running out of money to pay for it, but the essentials themselves are in full production. They're available. The shelves are full. Okay.
Yeah.
So do we want to get back to where we were by resuming the consumption of non-essentials at the expense of environmental degradation? Is that just substituting one non-essential for another, or have we added a non-essential and eliminated an essential, which is to eliminate this environmental degradation? So am I part of that? So if you're asking me what I would do, I have to understand where the position is on that. Me personally, I would not add back non-essentials that also contribute to environmental degradation. So I'd have that outlined first.
Yeah.
So things that will be coming back, things that we're doing, are not going to be things that wind up reversing what. Look, if we hadn't had COVID, we never could have gotten to this level of environmental degradation in 30 years with all the green deals coming out.
Yeah. So
we've gained through conservation. I don't know if you remember, we talked about it or not a year ago before COVID. I said I think we can save 50% on conservation in this new Green Deal without spending a dime or resource, just through conservation. And I think this has proved it. Has proven it that because there are more non-essentials we could eliminate now. Some of them have come back, and with it comes a massive savings of in terms of the environment. So emissions and everything else. Yeah. Okay, so have we established that, or
I'm happy with that.
Is that part of my job? Do I get the job?
You got the job.
This is part of my job, and right.
Yeah, you got it. If I was that,
so number one, I'm not. We're going to have to look at the areas that we don't want to come back because they're not environmentally sustainable. Whatever they're not, they don't meet our environmental goals. We're just not going to have them.
Yeah.
Right. And so I've got a lot of detail there, but we're running out of time. So the next thing is on the financial side.
Yeah.
So we want to. How much financial support do we want to give, and who do we want to give it to? We want to sustain demand so that people can live without desperation. But as work comes back, we want them to shift back into employment because otherwise what we have now is a massive supply shock. Fortunately, it's been largely non-essentials, but if we're going forward, we'd like that supply shock to get reversed in terms of essentials. And so so how do you do that counter-cyclically? Well, that's through unemployment compensation. So I proposed $500 a week on federal unemployment compensation because not that it's necessarily exactly the right number, but if the economy gets worse, more people are going to get it. If the economy improves, it's going to go away. So it's kind of a one-time thing in that sense until we get back to normal levels, much lower levels of unemployment. And part of that comes with it is the job guarantee, but job guarantee doesn't do you any good if it's not safe to go to work.
Yeah.
Who's got things to do? Who doesn't? So a job guarantee and unemployment compensation, I can kind of blend that in. And I come up with the idea of telling all the nonprofits that we will fund $15 an hour jobs, job guarantee jobs to anybody that are willing and able to work, anybody they want to hire. You can put them on your payrolls, knowing that when the economy picks up, you're probably going to lose them. But in the meantime, If you're the American Heart Association, you've got somebody there to help you take volunteers to the hospital or whatever you've got to do. Okay, so that plus federal and state unemployment compensation, kind of the same thing. So now anybody who wants to work can get in, and they will do things that we're only going to approve nonprofits who are doing environmentally correct things that we want to do. We're not going to do anybody that's going to get into non-essentials and that consume energy. So that would be my main counter-cyclical anchor.
Yeah.
Because the people who've lost the money are the people who've lost their jobs. Now, as far as small businesses and whatnot, those people have also lost their jobs, so they'll be getting paid, so they'll be okay. Do we care if the restaurant stays open or if it closes? I'm not sure. I don't think that's high priority at the moment. Okay, but what is high priority is to make sure the owners don't starve, that they can eat, feed their family. The husband and wife that were running a restaurant are getting unemployment compensation. They fully qualify.
Yeah.
And maybe it would be slightly more for an entrepreneur or something like that who had it could be somewhat income adjusted, but it doesn't have to be. But they qualify, they're in. Okay, so once I've done that, I feel like I've given everybody a safety net who's now out of work. The people who are still working are making money. They don't need this safety. Now we have to look at these businesses like airlines that would have otherwise gone bankrupt. Bankruptcy is a state takeover. The bankruptcy court is a state agent. So when you go bankrupt, you are nationalized. And then you are liquidated, brought back, whatever. You are resolved under national law, federal law, your national law. All right. So I think, in that sense, one of my proposals was we need to, instead of just giving support to these companies, we should nationalize them, the ones that will otherwise fail.
Yeah.
And the same way we do in bankruptcy, where it becomes the ward of the court. And we decide at that point how much financing we want to continue for them to limp along and what happens to them, to the capitalization, to everything else once things, when and if they turn around, when and if we want them to turn around. We may not want airlines again. Okay, we may decide we want to cut flight by 75% or something because of the environmental side. I don't know. So we don't just want to have people fly as much as they can afford. And maybe there was too much flying before. Maybe there was too much traveling before. Maybe it's not something we want to encourage. We want incentives not to travel and other things, which would mean airlines and other transportation networks shouldn't be there. There's a particular fascination with the rails in the U.S., trains, high-speed rails and all that. Well, we used to have a saying in cars, boats, speed costs money. How fast do you want to go? With more speed comes more environmental degradation. So maybe we don't want things to go so fast. It's like an inverse square law. And, and if you notice, the rails cost a lot more than the buses.
Yeah.
Why is that? Well, might be because there's more resources being torn up. Sometimes that has something to do with the cost, right?
Yeah.
Maybe, and so, and I'm getting off on MMT, but I had this idea that if we just had the buses run on the same lines as the rails do, just pave the outside of the tracks and let the buses straddle the tracks, they wouldn't have any traffic congestion problems. They run relatively dirt cheap. They're now being electrified, which is the ideal place for them to be electrified. They wouldn't even need batteries. You could have, connectivity along these rails like this. And we don't have to go at 120 miles an hour. We could go at 40, 50 miles an hour and get there quickly because there's no congestion along the rails. And then they're much more efficient. You get 20 or 30 or 40 people, the bus goes. You don't have trains that are running back and forth empty all the time.
Yeah.
And so anyway, those are just the directions I'm thinking.
Well,
I've got a really interesting thing for you, by the way.
Sorry, go for it, Warren.
You're going to want to see this. Okay, what has MMT accomplished in the last 30 years? It's been a grassroots movement.
Yeah.
Okay, there's not a single person with what you call credentials involved. None of the academics, I don't care how, I know that some of them are the best, but they're not known as the best. Okay, none of them have what we call Ivy League credentials or top academic credentials. None of them went to any of the top economic schools or came from the top political connections or anything else. Everybody has been grassroots from the bottom up. Stephanie Kelton, who is now, I'd say, the most influential economist in the world. I mean, Bill Mitchell, maybe because, of his, he's out there doing the same types of things. But Stephanie, with her book and the whole international thing and the whole way it's formed the thinking in the U.S., we just went through $3 trillion and now $2 trillion more of fiscal. Nobody's even talked about taxes. The word taxes never even come up. That would not have happened a year ago without Stephanie and her book and what she's done. So I'm not, even if people don't want to speak to her capabilities, they think she's all wrong. They think she can't tie her own shoes and she's part of the squad, or whatever they want to think. They can't take away the fact that she's the most influential economist right now in the world. And maybe Bill's there, but less on the headlines because he's been influential in the UK and Japan, Australia, China, and places that were not under the radar. But Stephanie's there on top of the radar.
Yeah.
In terms of name recognition and everything else. So how did it get there? What was it? What is MMT? MMT is a grassroots movement that started with one person, then two, then four, then eight, word of mouth. None of them celebrity status, with any celebrity status, no noted experts. But what are we spreading? We're spreading the idea that the central bankers in the world, the leading economists, don't understand monetary operations. Okay, we're not trying to cure COVID. We're not talking about saving the whales or any visible cause. Our cause is they've got the debits and understanding of the debits and credits in the Federal Reserve wrong. All right. So how probable is it that a group of people starting with 1 to 2 to 4 to 8 would have multiplied into this massive force in the world that's managed to forever change mainstream economics, finance, politics, everything else, okay, over an understanding of accounting? I mean, that's like, does that make any sense?
Yeah.
Is it probable? Like, what kind of a cause gets together? Okay, the revolution starts because of injustice.
Yeah.
Where we've got massive systemic racism. And so you get movements behind this stuff. We have an environmental movement, okay, that's working.
Yeah.
This was a movement to change the understanding of monetary operations in the Federal Reserve and the central banks.
Yeah.
By the central, of the central bankers themselves.
Yeah.
Yeah. And it's done and got the job done when all these other things that have real causes are struggling.
Yeah. Well,
I'm not saying they won't succeed, but I'm saying, like,
who's going to pay for it? That you said it.
Yeah.
They always say anyone who's good, well, who's going to pay for it? Now,
right.
Hit that question out the park.
Yeah. So the answer is you don't understand monetary operations inside the central bank. You don't understand this. So yourself, all these other people who've contributed to this massive movement of individuals who don't know anything about monetary operations have managed to get the understanding changed. How probable is it that would have ever happened, or people would be dedicated to doing that? And it's like, it's worth taking a look at, to take a step back and look at it. You say, I look at things differently. And I'm just astounded that, you've got this. I have a poster that we used at one of those protest things. And it said, I just put on my Facebook page way back from Bulgaria, I think. It said, we demand aggregate demand. I mean, that's pretty wonky, right?
Yeah.
And it's somehow gotten there.
Yeah.
So my hat's off to everybody involved and the fact that they're doing it and how successful they've been, on a one-to-one basis, and how, the dedication and the intensity of the whole thing. Yeah.
I think it's because MMTers think they can make ultimately the world a better place. It might be founded. Mantra.
Yeah. By changing an understanding of accounting identities.
Sorry?
Yeah, by changing finance's understanding of their own accounting. It's like, okay.
The first little domino, you knock it, And then all these other causes, if you understand the monetary operation,
they're all based on it.
These things fit. We just got to do that first, you know. I mean, sometimes I talk to people who are on about all the world's problems, and I say, look, let's start with the money. And they look at me and say, look, we've got to, this is your starting point. You know what the first question will be? Who's going to pay for it? So we've got to get that dealt with first. And it's not difficult. You know, listeners are thinking, it's not difficult. And they'll all be inspired by what you said, Warren. You know, I'm sure they will be. Sarah had a great question. I thought she was going to ask it herself. Okay. I'm going to try and paraphrase it, and with forgiveness. Now, what Sarah's question was, I think, was in the 70s when, if you like, the beginnings of neoliberalism, Bill talks about in Britain in the 1970s, suddenly everything was changed, markets work, you know, we've got to view the world differently. Surely, what's the puzzle? How in such a crazy way to view the world? What about the guys there then? What were they doing, sitting on the hands? How did it happen?
That was our buddies, the Keynesians and the post-Keynesians. Okay. It's the headline left. It's the headline left that's been the whole problem. Their only answer to the 70s inflation was price and wage controls. And people didn't want the government coming in telling everybody what they could pay and what they could charge. They didn't want that. And so the alternative was this monetarism, which, while it didn't work, it bought enough time for, OPEC to demand for oil to collapse in 1980 for a variety of reasons. And OPEC collapsed, the price of oil came down, the inflation went away. And at the same time that monetarism had started, which had nothing to do with that happening, by the way, and it was all fiscal stuff that made that happen. The U.S. economy went into the fiscal got very tight in 1979, and demand collapsed. And in real terms, because the inflation was so high, the actual nominal budget deficit in real terms went down. We were running what you call a real surplus, right? So the inflation adjusted public debt went down. And so we had a big collapse of the economy, and demand for oil collapsed. Oil prices came down, and it was all monetarism happened to be in the right place at the right time to get the credit for it. And that's still lingering. Yeah. And the post-Keynesian response of price and wage controls hadn't worked during the 70s, and that was just considered a failure and was immensely distasteful. And again, because they didn't understand the source of the price level and came up with the wrong answer. And so here we are.
Yeah. Yeah. And you know, Sarah sent something to me, which was good. She's just asking, with the COVID crisis, do you think it's been used as a bit of a smoke screen for kind of neoliberalism 2.0? Are things that are somewhat undesirable being hidden behind there with maybe related to this great reset? I mean, I've not heard of it. I don't know if you have this thing from the World Economic Forum. I don't know if you've come across that. But do you think that it's a bit like the Arab oil crisis was a sort of a, I don't know, cover for bringing in the more Pellerin society ideas? Do you think COVID can be a bit of a smokescreen for neoliberalism too?
Well, for the neoliberals, that's all they know.
Right. Okay.
And so the ones I've talked to, they kind of pontificate a little bit, not trying to be offensive, but that's all they can do. And they that's all they know. Yeah. And they don't know anything else. And what do they say? A lot of the people have been successful making money or successful inheriting money. Yeah. And so they're the ones who get hurt, and that they went to the right schools, and there is no other. They don't know anything else except at all. So I don't know. Yeah.
I know we're a little bit over time, Warren, but my last point really is just for giving.
I've got time. It's up to you.
All right. Well, if you were giving like a closing message, like a little feeling for the activists, what advice would you give us? Maybe generally, or I don't know whether this has gone global, but for MMTers in Britain, or what should we be focusing in terms of how our interaction with political parties, pressure groups, interested individuals? If you're inspiring your MMT activists, what would you say? Other than you've already said it's a fantastic grassroots movement. What should your grassroots followers be doing, really?
Yeah. So somebody flashed up a question about robots. Can I address that quickly?
You can, of course.
Okay. So let's say we have robots doing everything.
Yeah.
And so nobody actually has to work. But then they put a tax on everybody's house. If you don't pay the tax, you're going to get your house burned down.
Yeah.
Well, and now you're looking for work to get that money to earn the tax, even though you don't actually need it. And if they tell you, okay, you got to all have to dig holes, and half of you are digging holes and the other half are filling it in, well, that's what you're going to do. And you're unemployed until they give you that job. So don't confuse a productivity story with an unemployment story. Productivity is good stuff. That's what gets us here. We want as much productivity as possible so we get the most out of the least effort. We can get the most things back. That increases our real wealth. We want to be able to cut the grass with lawnmowers instead of scissors, so we can.
Yeah.
Okay, and so the unemployment story is always an unspent income story. It's always a monetary phenomenon. It's always about the population seeking the money to pay the tax and doing what the government says you have to do to get it, either directly or indirectly. There's nothing more to that story. It's got nothing about doing with productivity. Okay, so back to your question.
I'll give you a little story, Warren, which just fitting with your robots. You know, you people also robots and technology always takes away jobs. You know, and I was always thinking you always get more jobs when you bring in technology. I mean, when I started teaching, there was only 3 basic types of adults in a school. You have the teachers, you have the dinner ladies, and then you had kind of the secretarial staff stroke caretaker, and that's all you had. And the main adults in the building were teachers. Nowadays in the school, you wander about, a guy walked past, said, who's that? He was the website manager. What? Then there was a business manager, and they have loads of IT technicians because all we got all this automation, the thing goes wrong and they have to fix them. And there's loads of them. We've got a massive marketing department. So this, you know, they were on about it in the 19th century about this automation. And now, like in the 70s, apparently now we're going to get robots delivering our tea. You know, in the morning it would come up. You know, but I'm working long more than I've ever done. I'm in my 60s. Yeah. So it makes me laugh that in a way.
Well, that's actually a bad thing. That's actually negative productivity if it takes more people to do the same thing. Look, we get up in the morning, and there's always more to do than there are people to do it in the world.
Yeah.
Always. And you could ask people, how many of you would like to hire a personal assistant just to help you out with what you do? You're a university professor. How many research assistants would you like? Yeah. You're at home, you know, taking care of the house. How many assistants would you like to help you with your emails and your pictures, and taking care of your correspondence and helping you in the house, whatever you're doing? So everybody would raise their hand and say, yeah, I'd like to have a personal assistant to help me. And you say, okay, well, let's say the government said we'll give you everybody enough money to hire a personal assistant. So you could all have one. Well, then how many personal assistants will there be? There won't be any. Because if everybody wants one, who is the personal assistant? Nobody. I mean, there aren't any. You all want one. Okay. So we start off every day with at least 100% labor shortage. Okay. Before any of this other stuff you talked about. So there's a massive labor shortage all the time. Unemployment is about a money shortage, not a shortage of things to do. It's a shortage of funds. It's what a friend of mine called the money famine. Yeah. So
you don't have to come
up with things. You don't have to come up with things to do. There's always way too much to do. That's the human condition. There's more to do than there is time to do it. Right.
Yeah. I didn't have time to paint the ceiling as well as do the garden and prepare for this interview. Yeah. I'm going to sneak another question, Warren, if that's all right, from Sarah, because, you know, she's one of the national treasures, as you know. She says, you may be able to see it on your screen. I don't know. It says, Warren, can you talk briefly about the compliance costs of collecting tax and the removing of drag from the economy as per an athlete?
So the compliance costs are the costs of everybody having to do a tax return, all the record keeping that everybody has to do to keep track of how much money you make, all the record keeping that your employer has to do that they wouldn't have to do for taxes, paying tax consultants, tax attorneys, all the university time of learning all these jobs, all the tax compliance work that businesses do, all the time spent in court, all the appeals and all the trials and all the offshore real resources that get used in terms of part of compliance is to decide which country to set up in and where to do it and hire people there and have offices you wouldn't otherwise have. And when I talked to a friend of mine at the University of Chicago, and I said, I thought this could easily be 10 or 15% of GDP. He said, it might be more than that. So I don't know what it is, but it's staggering. Okay, so let's say it's 15% of GDP for a number. So that means if you abolish the income tax and went to, let's say, a property tax, and I know there's Georges and all these people for property tax. Let's say you did it just based on the idea that the compliance cost for property tax, almost the government takes the property and sells it. They don't even care who owns it. So let's say you've got near zero compliance costs. So now you've just saved 15% of GDP. Well, most of that is services. We're in goods and services. So we're not going to get more things for sale at the grocery store because there's already enough to eat for everybody. But you're going to be, all these new public services or private services will be available. And so let's look at real consumption. So who is going to increase their real consumption? Okay, so people in the upper third income earners population, older people, they're probably not going to increase their consumption all that much. Older people might have better service at the nursing home or something like that, but they're not large consumers to begin with, and they're not restricted by money, so to speak. Okay, so if we get a 15% increase, I'm probably going to go to the lowest 60% of consumers, which means they're going to get a 25% increase in real GDP. The lowest income earners are going to get a 20. And if a lot of that's public services that are available to everybody, like better free education at an enhanced level for everybody and that type of thing, it means that it's an enormously progressive thing to do, because if you look at the distribution of consumption, which is what ultimately counts, then you're helping, that will improve, if there is a Gini coefficient for that, dramatically as the lower income earners' consumption of real goods and services goes up disproportionately to their income, many times their income, where it'll only go up a fraction of where they are for people who are in the upper half, let's say. So, they're still only going to eat 3 meals a day. They're not going to take more vacations or fly more in private jets. They're already going wherever they want. Okay, so one of the more progressive things that we could do would be to eliminate income tax to get rid of the compliance costs. Now, yes, there is progressivity to the income tax that we would lose in a progressive sense, but in a real sense, the gains are staggering versus that loss. And that loss, isn't all that much to begin with, because compensation is more by net income than gross income. You can look at gross minus taxes, but at the end of the day, you have to go by what you can live on. It's net income. It's a net that you should be looking at. In fact, the IMF and other agencies don't even count gross income for people that work for government and related agencies. They just look at net income. And if you replace it with a no compliance tax, again, like a property tax on real estate, then I think we've taken an enormous step forward in terms of progressivity. And then the way I go after the distribution of income, that still is going to be an issue, is to go after it at source rather than trying to use a tax structure to capture it after somebody's already got the money, because that has historically not been successful in spite of really well-meaning attempts over the years by a lot of governments. And so I'm not sure I can do it any better than the people who've tried and failed, but I sure can get rid of the income at source. And the big test has been my proposal for a permanent zero rate policy. And I've noticed that in the last few years, the income distribution spread has not been widening the way it was earlier. And I think a large part of that is the zero rate policy has taken away all that interest income from higher income earners. The basic income for people who already had money has been taken away, and it's having its effect on keeping that distribution from widening. And but there's not enough data out now that I've seen, because nobody's actually been looking for it. And I always see 30 years of data, and I have to look at the last 3 years on that 30-year chart and say, hey, looks like it flattened out a little at the end.
Yeah. Now, Warren,
because nobody's actually gone into that detail. Yeah.
There's a little message. Addy I might pronounce his name wrong. And he says, "Thank you, Warren. You are an unfailing inspiration to us grassroots toilers." And then adds the very topical point, a robot couldn't do that. So now, just as your partner, because we're all getting a bit tired now, I could listen to you all night, but I ought to go make an appearance. The dogs are back. But basically, that last point I made about what, if you had a short sort of what we should be doing, what sort of give us, that last point before we talk about robots.
Yeah. So we need to. The three things would be, number one, on the financial side would be the unemployment compensation. And then number two, the job for anybody who wants one. And of course, all in the context of not going backwards, in terms of environmental degradation, but going forward. Number three, the states, municipalities in the US, at least, probably in the UK, because of the slowdown in rating their police protection and whatnot. So you need the central government funded by the central bank to support those through grants, which I say should be done on a per capita basis to all the state and local authorities. In your case, would be the cities and the towns, whatever local authorities you have throughout the United Kingdom. Everybody who's under pound sterling should be getting on a per capita basis a distribution to their local public services to support their local public services. Those are essentials. They're not resource consumers. And I think those three things would be sufficient. We then have another political imperative, which is to make it safe to go to work in areas where we want people to go to work, where don't degrade the environment.
Well, thanks, Warren. It's been brilliant. We've run over time a bit, which I'm sure no one will be worried about. It's been a real inspiration. I hope everyone's looking forward to our Weimar paper on the website. I'd like to point out to you, please go to the GIMS site, see what's on there. Go on to Warren's site if you haven't been already, on his mandatory readings. There's so much great stuff there. Look at Warren's book, 7 Deadly Innocent Frauds, Soft Currency Economics. So there's brilliant.
All free online.
All online, all there for you to enjoy. Keep in touch with GIMS. I'm sure if Warren's enjoyed it, he's a popular man. A lot of people like to interview Warren. Apparently, you've been interviewed already once today by someone else, I've heard. So we'll try and get Warren back, return of Warren, when I can ask him about boats and cars and other things I just didn't have time to. But I'll wind up there with a huge thanks from me and from GIMS and on behalf of all the people tuning in. Thanks, Warren.
Thank you. Thank you, everybody. I got your messages and very much appreciated.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino, and you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.